All right, so Adam Chronister here, and I wanted to share with you guys a little different video than the last few I've been posting. I, of course, post a lot of videos on digital marketing. That's what I do most of all, but when I'm not doing digital marketing, I spend a good share of time kind of investing and looking at investments. My wife and I have been doing real estate, buy and hold, for a number of years. And a number of years ago, I felt like I had a decent grasp of that world and really kind of felt like I was behind as it relates to investing in the stock market. So I spent about 2 or 3, probably the last 3.5 years really diving in, trying to get my hands on any type of books or materials as it relates to stock investing. So I've read a lot on the topic and found stuff that made a lot of sense, others that was kind of over my head. But I wanted to share with you my investing strategy and help kind of people better understand at least what I do, only because I get a lot of questions about it. I will mention first off, I'm not a investment broker. I'm really just some guy on the internet, and so take that in mind. I'm not necessarily recommending that you do what I do or invest like I do. However, it is a strategy that I've learned through a lot of the materials I've read. I've implemented it, and feel quite confident in my personal overview and strategy as it relates to what I do for myself and my family. So, first of all, I wanted to talk a little bit about, fear as it relates to investing in the stock market. So this is an article, Zombie, Vampires, and Stocks, how to banish your investing fears. And this seems to be one of the biggest issues with investing. I find there's two real issues. One is fear, and one is just the pure overwhelm of, I don't even know where to get started. I have these plans from my employer, I have this 401k, but I don't really know what's going on there. How do I go above and beyond that? And so I think both fear of losing your money or making a bad investment is what keep people from really actively managing their portfolio, and then also just the pure overwhelm. And a lot of the overwhelm stuff, as well as the fear, is really what I want to get down to, because if you can get over those things, really this can be not only fun, but of course it can be something that can value your life, make you better prepared for the future. And so that's my objective, is to share some of the things that I've learned with you, so hopefully you can be better informed on the topic. So many of us kind of still remember the 2008 stock market crash. I know a number of people personally who lost a lot of money in that crash, and the memory is still with many of us. And so it's with these kind of things where people start to get afraid of the market and maybe think or have bad ideas that it's just a place to lose your money, that it's really gambling. How many of us have heard people say, oh, investing in the stock market is really just the same as gambling? And realistically, there's nothing that could be further from the truth. However, there are a lot of ideologies and really emotional traits that can put you at risk, and that's also part of the whole dynamic. So I want to talk about some of the trends that you will notice in the market itself. What this is a chart. It only goes back to 2000, but it's the total stock market. So it shows you peaks and valleys for the total market as a whole. Now, there are some interesting things. So on average, annually, the stock market returns 10%, but that's an average. So we look at the example of 2008, the crash that I just talked about. A lot of the people that lost money, they lost money not because the stock market crashed. They lost money because they pulled their investments at the wrong time. And this is essentially what happened. As the market started to dip, people essentially cut their losses and pulled out all of their money. However, if they would only have ridden the ride, and waited a couple years, not only would they have recouped all of their money, But fast forward a number more years, they would have, increased their money multiple times thereover. Now, Warren Buffett has a saying. He says, when others are greedy, be fearful. And when others are fearful, be greedy. And so really, if you were almost just to do the opposite as what most people do, just by doing that alone, not only in stocks, I think this is often true in life, you'll typically end out ahead. So let's say, for instance, this was you. You saw that your portfolio was dropping. Unlike most people who pulled out their funds, quote unquote, cut their losses, you said, I'm going to double down. I'm going to stretch my pocketbook maybe a little bit, put some more money into the market. Think what that would have done to your portfolio. And that's exactly the kind of strategy that I typically do. And I'll talk about that in a bit here. The first thing I want to talk about is, I guess, different types of funds. So sometimes I will mention on my Facebook and with other people investments I have in individual companies. So I do have some investments in, for instance, Tesla, Apple, and a number of other companies. But that's really a very small fraction of my portfolio. Only because I know that those things are really going to be a lot more volatile than a larger index fund. And so I do that as more of a fun thing, but it's a very small part of my portfolio. And I'll explain that a little bit here further. But essentially an index fund is a pool of funds. So we know, for instance, the S&P 500 is the 500 most popular funds in the market. So that's a pool of popular funds. You have the Dow Jones and a number of others. So the biggest difference between an index fund and investing in an individual company is the amount of risk that you put in. So if you put all your cards and all your funds into an investment, say like Apple, chances are you could get a very nice return. But also, it's a single point of failure. If they have a bad earnings, or maybe things go south, you're going to lose a lot of your money. And so while it can be kind of fun and exciting to invest in individual companies, and I do a percentage of that, I really like to make sure that my money is secure and sound. And that's where index funds come in. And I'm going to talk about one particular index fund where I put most of my money in just a bit here. So first of all, though, let's revisit the idea of inflation. So some people say, well, I'm just going to put my money into a savings account. I'm going to let it sit there, and at least I know it's not going to lose money. But the reality is that's just not true. If you were to take all of your discretionary income and put it into a savings account, not only are you probably paying fees for that account, but the average inflation rate is roughly 3.22%. So by putting all your money into a savings account, you're not really saving any money, most likely, because the average returns on a savings accounts are like 0.02% minus the rate of inflation. So you're actually losing money by putting money into a savings account. And that's why you really want to look at some other options for safe havens for your money. So if we know inflation is roughly 3.22%, there's some other rules we can look at as it relates to stocks. So on average, the stock market annually receives a return of about 10%. So there's what's called a 4% rule. The 4% rule is essentially a rule that states that in retirement you should withdraw about 4% of your overall portfolio. And this is based on these ratios of the 7 to 10% return minus a 3% inflation gives you roughly 4%. That means you can skim 4% off of your holdings and your money still keeps growing, so you're not actually dipping in or negating your stock investment. So it's a way for you to essentially skim the cream off the top of an investment portfolio and, in theory, live off of that investment for the rest of your life. And this can really inform an intelligent future forward investment strategy. So let's look at this scenario, for instance. Let's say, for instance, in retirement, you're confident that your house is paid off, your vehicles are paid off, your bills are relatively low, you believe that you could realistically maintain a level of lifestyle that you're accustomed to for $40,000 a year. Let's say that's you. So the 4% rule would only require $1 million in your bank. And I know people are saying, well, only $1 million. But again, we're thinking long term here. So we're depending on how close you are to retirement. That's maybe 10 years, 20 years, 30 years. So this is big picture, and this is really the goal. It's in one set scenario. So again, understanding this 4% rule can help inform some of our decisions as we're planning for the future and for our retirements. It's a good rule of thumb to look at. So I wanted to talk about another index fund, and this is what I do, to a T. So outside of funds like the S&P 500 and the Dow Jones, there is what's called a total stock market index fund. And this is one of the ones that I utilize. It's through Vanguard. The reason I like Vanguard is their fee structure is one of the lowest that you can find. But essentially this VTS AX fund, and there's also the VTS MX and a couple similar, but they all essentially are the same thing. It is a index fund of the entire stock market, meaning that I own a very small fraction of every company on the US stock market. And again, knowing those legacy rules like the annual returns and knowing ideas around things like the 4% rule, this is a fund that we can invest our money into, knowing that we're going to be beneficiaries of those average rules. The other thing that's important with these kind of funds, and any fund you look at, is expense ratios. So the expense ratio, basically meaning the cost to be involved in this fund, is very low. It's 0.04%. If you were to compare this to, say, a 401k plan, you're going to probably see some stark differences. One of these total stock market index funds, I think the minimum to invest is like $10,000. This one, I think, is the smallest one, and the investment minimum is $3,000. So if you have $3,000 to put aside, you can get into one of these funds right away and then start adding money to it on a regular basis. Let's see here, and that's kind of another part of my strategy. So dollar cost averaging is something you may have heard of. Essentially, what this means is that you're putting away money on a regular basis. You're not doing swing trading necessarily, where you're paying attention to the market and checking it every day. I do check the market quite a bit, but I know that it's more out of fun and less out of necessity. I'm not a swing trader or a day trader, so when the market dips or goes up, it doesn't concern me so much. In fact, when the market dips, that's usually the only time I look for opportunities, and I can talk about that in a bit here. But dollar cost averaging is the idea that you're going to be putting in almost like a savings account, a certain amount every month that goes into your account. So going back to Vanguard and any index fund, first of all, I should mention Vanguard is not the only brokerage that has a total stock market index fund. A lot of other brokerages like Fidelity and others are starting to, as a part of their competitive nature, are coming out with these funds. So you can get these elsewhere, but again, Vanguard typically tends to be one of the best deals out there. And also they can help you with this. They're very knowledgeable, so you pick up the phone, even if you don't essentially know what you're doing, they'll help guide you with that. But I'll give you an example of my strategy. So with my dollar cost averaging, I have a monthly amount that I pull out each month, and sometimes I'll look for opportunities to add more. So for example, last January, the market took a real big dip. So we went up, from $72 in this fund down to, what is it, 59. So for me, I have money coming out every month of my checking account into this fund, just like a savings account. But when I saw that dip, I said, okay, here's an opportunity to, to borrow from my pocketbook, put a little bit more than I would normally, because I know, again, based on the average returns, I don't know when this is going to recover, but I know over time that this dip is going to go back up, just like it did in 2008. Now, in this case, it took, it took, gosh, almost 2 years. But I know in time, the market's going to keep going up. And so it's with that you can not only have a dollar cost average type scenario where you're putting aside a little every month, but you can actually take advantage of these drops to further strengthen and compound that scenario. Here's an example. We are in the month of October. The month of October is traditionally one of the most volatile months. So I've been paying a lot more attention to dips in the market. And actually saw a small dip. I put a little bit more than I would normally as a result of that. So you can play with these trends, again, to know when to put a little bit more money in than normal. And something to keep in mind there. Now, I wanted to talk about a couple other scenarios because a lot of people have funds maybe through an employer, and there's things you want to pay attention to with those as well. So a lot of 401k plans that you have will have a lot of different options. Sometimes they can be really confusing. Some of the default options in there, often they're pushed for convenience and ease of use. Like they have right now, the target date retirement funds are really popular. And the selling model here is that, hey, this portfolio adapts and it strategizes your earnings based on where you are in your retirement scheme. So the closer you are, the more conservative it gets. And while that sounds nice, what a lot of times people don't really call out is, again, those expense ratios. So in this target date retirement fund, the expense ratio is 1.18%. So that 1% may not seem like a lot of money, but when you remember that you're going to be paying taxes on a lot of these funds at the point of retirement, 1% can be a huge amount of money, especially if you're talking about a retirement fund of, 100,000, 200,000, 500,000, whatever it is, 1% can really chip away at that. So a lot of these funds will also let you kind of self-direct. And so with a little bit of research, for instance, this is another option. It's the S&P 500, essentially the same S&P 500 that has the 500 top funds. I noticed that the expense ratio is not even 1%. So while that other fund has a lot of promotional perks in that it self directs, you're going to be paying a lot more for it. And so it's also good to really know what you're looking at and not just go with default options, whether it's with a employer option or it's one you're looking at directly. So something to keep in mind there. The Roth IRA is something that's really interesting. A lot of people have heard of this, but a lot of people don't know exactly what it is or how it works. The nice thing about a Roth IRA, and you can also employ this through Vanguard, is that it offers tax-free growth. Basically, it's a tax-advantaged account. Basically, as long as you've owned your account for 5 years or your age is 59 and a half or older, you can withdraw the money when you want and you won't owe any federal taxes. So this is a really good option. Right now, I believe the cap for that is $6,000, meaning you can't put more than $6,000 a year. Anytime the government restricts you from saving money, it's typically because there's a tax benefit that they don't want you to take excessive advantage of. And so this is something, if you have the money and the resources, certainly would invest in this because it's tax-free or tax negated savings essentially there. So the key benefits of doing a Roth IRA conversion. Oh, I didn't talk about this. So a Roth IRA conversion is another really good tool. Let me see. I think we talk about this. Basically, what a Roth 401 version is you can take an older employer's 401k plan and transfer it to a Roth IRA. So if you have an employer that you're no longer with, but you have a 401k plan, you can have this rolled over to, say, Vanguard or another fund and pull it into an IRA. So not only do you have some of the benefits on a fee structure, but there's other benefits as well. I've done this, for instance, with a previous employer's plan. I rolled it into a Roth IRA, and now I'm getting lower fees. I have more kind of direct access to the income should I ever, needed to pull that. Of course, I'm not going to do that till retirement anyway. But there's a lot of benefits there. The fee structures. So the fee structures to keep it into my old employer's plan were much higher than the Roth IRA. So I'm actually saving money in that respect. So again, the key benefit of doing a Roth IRA conversion is that it can lower your taxes in the future. While there's no upfront tax break with Roth IRAs, your contribution and earnings grow tax-free. So again, another big benefit there. Some of the books that I would recommend if you really want to learn this stuff, and this is where I learned a lot of this stuff myself. This is probably one of the better books that I would recommend anyone read. It's called The Simple Path to Wealth. It's by J.R. Collins. Essentially, this book was authored as really advice to the author's daughter. His daughter, essentially said, look, I know you're into all this investing stuff, but why don't you just tell me what I need to do? So he started writing this book as a directive to that request from his daughter, and has since published it. And it really kind of simplifies stuff, breaks down a lot of the strategy that I've outlined here. So this is a really good book. I highly recommend it. If you want to shortcut that, there's the Choose FI podcast and the stock series where they interview the author here, and he rolls out a lot of the strategies in this podcast series as well. So if it were me, I'd probably read the book and then do the podcast series, but you could probably skip some of that, but you may be missing a little. But in general, he lays out all of this here. The second is Money Master the Game. It's not your typical Tony Robbins book. Basically here he's interviewing some of the top as far as money management and investing. And again, his objective, similar to J.R. Collins, is to really demystify investing. And I think he does a really good job in this book with the interviews that he pulls out and the takeaways. So these two books are probably the two that I would recommend if you really want to simplify your understanding of investing. There's a lot of other good books. I've read a number of Warren Buffett books and others, but these two can really kind of make you feel like you have a good grasp and understanding of how to invest in this, in the stock market, and not feel so worried or scared or overwhelmed by the data that's out there. So anyway, this video really came out of my desire to share some of these things with people who, want to feel more secure in their investing, want to feel like they can do it themselves without too much hand holding. And so hopefully this has benefited you. If you have any questions, I'd be happy to answer any of those that I can. So thanks.